The SPIN ETF from State Street, the overlooked 8% yield covered call powerhouse, it's sleeping on a gold mine and most people don't even know about it. We're going to break it down today to give you all the insights of SPIN and see if this is not a ETF that should be in your portfolio when you're looking at long-term income for retirement. Well, before we got to get into this, we do have to do a disclosure because we're technically rated as a financial channel, but the past performances do not guarantee future results, and the information provided in this video is for educational and informational purposes. It is not to be considered financial advice. So the overlooked 8% yield, the ticker is SPIN. This comes from State Street's, and we call it the quiet powerhouse for income investors. The current yield of 8.49%. Now, I'll tell you straight out, I'm not a yield chaser. I don't watch that. But what I do watch is total returns. And off of 1 year is a 9.07% total return. So not only are we looking at this as a nice income generator, it is also a nice total return because you do have a little bit of potential growth. Now, that number's down a little bit basically in today's marketplace with the Iranian war going on, the oil going which ways. But as soon as that straightens out, I truly believe that total return will continue to grow because we're going to get growth along with that current yield. So let's find out how they do it. So the modern income crisis in 2026, why your traditional income sources are failing. Well, as we have the inflation pressure, essentially the costs like housing and insurance remain sticky despite interest rate shifts. So even with the interest rates going down, we're still having the cost of living going up. So the two profile strategy that they use, modern investors require separate buckets for long-term growth and high yield monthly income. And the record inflows, cover called ETFs have seen a massive adoption since 2022 as a tool to offset rising costs. 52% of Americans report that their primary income no longer covers essential monthly expenses in 2026. So wage growth is actually slower than essential costs. And that's a big problem that we're facing in America, along with the retirees are feeling a lot of these similar type pressures. So what is SPIN's strategy? What is their philosophy? What are they basically doing? But owning the underlying assets rather than relying on synthetic exposure, SPIN favors transparency and direct equity ownership. Now that's a unique piece because so many companies out there have come up with the idea if we do the synthetic exposure, which is we'll hold money on the sidelines, you'll promise to sell me your funds, and I'll sell them as covered stocks, but I'm not going to pay for them up front. It's like a buying on time. And there's a lot of issues and costs of that. That's why SPIN, and that's why I kind of like this fund, is the transparency that they've done, that they own the actual stocks. So the physical ownership, unlike synthetic funds that use swaps, SPIN actually holds these US equities in the portfolio. They market selections. They target established large and mid-cap companies with market caps exceeding $2 billion. So they're not buying the little speculative ones. They're not buying the ones that are, hot flash. Maybe someone's really talking about it. They're buying into it and then promoting it. They're buying the hardcore names. The option overlay actively writes short-term call options to harvest premium income without sacrificing long-term growth. Another unique piece. Okay, so they're writing shorter term calls and they're trying to drive that premium from what they're actually owning. So when we look at this, here's some of the features. Your assets under management is the actual equities versus the derivative or swaps. The upside capture, it's higher because it's organic. As they have upside of the fund, If a particular stock, and I'll square NVIDIA right now, if NVIDIA goes up, these guys are going to see the advantage of it. But with synthetics, they're limited. They've already agreed to a price. They've already agreed what they're going to sell it for. There's nothing in between because they don't own anything part of it. And then the expense ratio, this is the one that blew my mind, is that they're at 0.25%. While you see a lot of the synthetic peers at 0.35 to 0.65, I've seen higher up to 1%. So these guys are doing it for a lower cost, holding the funds, doing it what I call the old-fashioned way, and doing it well. So the portfolio is built on U.S. Titans, as I talked about. NVIDIA, 7.2% of their portfolio is NVIDIA. Microsoft, 6.8%, Amazon, 5.4%, Google, 4.9%, Apple, 4.5%. So they're heavy into technology, I'll give you that. They're also looking at consumer discretionary communication services. So Spin doesn't gamble on speculative small caps. They're focused on market leaders with caps over $2 billion. The fund captures organic growth from the AI revolution while maintaining a bedrock of stability. So they're not just dipping their toe in, they're putting their foot into the AI revolution. You can see the technology companies that they have there. But instead of having that, they place a bet on consumer discretionary, consumer services. So there's also the security that they have. Now, the secret sauce in there is their active management. Beyond a set it and forget it strategies, these guys, for 0.25, remember that, the expense ratio is 0.25, you have an active management. So they use the flex options. State Street utilizes a customized flex option to optimize strike prices, allowing for precise income targeting regardless of market volatility. They use a ladder strategy. By spreading out their options, the fund migrates timing, risk, and ensures a smoother, more predictable monthly distribution. And they active rolling. Managers actively close contracts near expirations and open up new ones to harvest higher premiums during periods of elevated market stress. What the simplest thing is I see from this, these guys are not going for the big numbers. They're not going for, we're going to get you 20%, 18%, 30%. They're not going for big numbers. What they're using is the old-fashioned strategies, the ways that got us here today, and not the flash in the pan. Now, here's what I explained to you on their option ladder side of it. Week one, 25% of their portfolio is set up for their options strategy. Okay? They have certain expiration dates. The other 75% is already scheduled out, but sitting open. Week number two, they roll to another 25%, which is currently where we're at today. Week three, they go to a third, and then week four. So they're only doing 25% of the portfolio at any one particular time. Reason for that is, if the market changes, if the market goes higher, the market starts to go lower, they can change their option strategy within 1 week. So they don't have everything outlined like you see a lot of funds out there that are all in with their strategy, right, wrong, or indifferent, they're all in. So when we take a look underneath the hood of State Street's U.S. Equity Premium Income ETF, which is better known as SPIN, the expense ratio I talked about, 0.25%. They have 1.78 million shares outstanding. Now, their past 12 months yield is 8.64%. They've paid out $2.57 per share. Now, it does pay out monthly, okay, and it does pay out in that normally first week of the month. And this came out September 4th of 2024. So this is not a new fund. This has been, we're a little over a year and a few months, almost a year and a half, outstanding already. And you look at it, April 2nd, we had that on there. We put that on the screen. It did drop off, but it did recover, and it's been recovering ever since. Now, you can see currently in the last 30 days, it's had its downfall, which you're going to see a lot of funds have because, as I told you earlier, oil issue, the Iranian war issue, what's going on with the government, the geopolitics playing into things. Everyone's seeing some struggling times right now. The question is, will it recover out of its gel? Will it come out as it works? April 2nd is a prime test of it. And we're going to see this thing do it, I believe, once more time. Now, that's my personal opinion. Don't buy on my personal opinion. This is not suggested. I'm just giving you the facts that I see on the board. You look at the dividends. The dividends they did have in the April, because of the volatility and what they were able to do, they had some big numbers. But since July, we're seeing a very steady trend across the board. Now, averaging right around that, 10 to 11, 12 cents per month per share across the board. This is, remember, an 8.64%. This is what I look at for in retirement accounts. Instead of setting money aside and saying, hey, I'm trying to get this big money that has big volatility, we're looking for smooth rides. So the performance. Now, here's the thing I do. I compare it to the other big ones that are out there. They're crushing the giants. Now, SPIN versus NEOS, Goldman, the GPIX, the JPI from JP Morgan, the SPYI from NEOS. SPIN in the past 6 months has beaten every one of them. Okay, they're dominating the leaders. SPIN has outperformed the industrial giant that a lot of people have in their portfolios, JPI. It's nearly 2 times the total return over the last 6 months. The total return focuses, unlike yield traps, SPIN captures an organic equity growth alongside its 8% distribution. Now, these numbers are all subject to change. These things can go up and down. This comes from Morningstar and Yahoo. Boy, I can't get this right. Yahoo Financial from March 26. So total return focus and consistency. It's normally consistent ranking at the top. It's State Street. They're not a big advertiser. You get NEOS, you get Goldman Sachs, you get JP Morgan. They're hiring people left and right to promote and advertise their funds. While State Street doesn't do it as strong. Okay, they're not out there promoting it. I'm not promoted by it. I find it because I do my own research and I dig deep into these things. And I show you this one right here. It's outbeating the other 3 funds, and it has the consistency to do that. Now, the cost efficiency. This is the one that really just put me over the top when I saw this. The industry disruptor. It's just at 0.25, SPIN offers the lowest expense ratio in a derivative income category. Like I said earlier, people are in that 3.5 to 6.5. I've seen some higher. These guys do it for 0.25, and they're actively managed. That long-term impact, that lower fees compound over time. So the longer you hold this, the more your money is working for you. This is the way it used to be, and this is the way I like it to be. Now, NAV stability. This is the one thing everyone always wants to talk about, is that NAV erosion. Those magic words are out there. Well, NAV erosion occurs when a fund pays out more than its earnings, causing the share price to decay over time. Now, there's a ton of it out there. I'm not saying that's not real. It is a true hardcore piece. And a lot of people have gone through it. And you don't want that in your retirement portfolios. And right now, a lot of people are seeing NAV erosions in their funds, and they're like, what do we do? The SPIN difference is that conservative 8% targeted yield allows for the fund to retain capital for growth. Capital preservation designed for long-term holdings who prioritize principal stable alongside income. This is why I'm not saying this is going to be the biggest fund, replace it all with everything. But we have the old-fashioned standard 8% item that's collecting money and with the potential of it growing because they've designed capital appreciation. This is actually income with capital appreciation. It's not a lot you see in a lot of funds this way. Now, the tax efficiency. With all good things, you always have to have a few, I'm going to call them negatives. Now, what I explain here is not really negative, but man, would I love to see them do something different. But life is what it is. They use the return of capital, which is great for retirements, it's great for everybody into it as long as they don't misuse return of capital, which I think a lot of people have done. Return of capital is a significant portion of SPIN's distributions are classified as ROC, which is generally not taxed in the year it's received. They kick the can down the road. Okay? The tax deferral, the ROC, reduces your cost basis. And I did a video on this before, and I'll probably link it down at the end of this. I'll link it down there. So you can understand ROC if you're not familiar with it. But basically, it reduces your cost basis, effectively deferring your taxes until the shares are sold or potential at long-term capital gain rates, which right now is 0, 15, and 20% numbers. Okay, so you could technically get out of this with no taxes at all based on your income. Monthly payouts, that monthly check provides reliable cash flow for reinvestments or for lifestyle expenses. Okay, if you're a retiree, you can take that 8%, that monthly payout, and use it to pay your bills. Okay, so you have the best of the world that you can get, 8% return of capital plus potential growth. Now the risk assessed, know what you own. Transparency for informational investing. You need to know that this asset under management and the liquidity is about $56 million in assets. Now, SPIN is smaller than some multi-billion-dollar peers out there, but backed by State Street. Lower daily volume may lead to a wider bidding-ask spread for the larger trades. So would we like to see it bigger? Sure, we always like to see a bigger equity. We'd love to see a bigger, assets under management. But State Street knows what they're doing with that, with their dollars that they're getting. The distribution variance. Unlike fixed income funds, SPIN's monthly checks does fluctuate. Okay? Based on the market volatility and the option premiums, investors should expect a variable in their monthly income stream. You saw on the chart that I showed you earlier, we've seen this thing in the past few months. It's been pretty cut and dried steady, but it's not one of those things that guarantee 10 cents every month, all the way through. You're going to see some 9 cents. You're going to see some 10 cents, some 12 cents. You're going to see things all the way through. So we get a balanced approach with it. And the market exposure. While the equity-based fund SPIN is not immune from broad market sell-offs, while the option overlay provides a buffer, the principal will and can decline during significant market downturns. We've seen that one as well. So everything I've shown you here as the risk factors, I've already shown you in the funds. So it's nothing, again, open curtains. Everything's wide open. It's honesty out to the marketplaces. But overall, I still think that there's a lot of potential in this fund. So the conclusion for 2026 outlook, the verdict is on SPIN. It's a strategic fit and ideal core holdings for the income bucket of your diversified 2026 portfolio. Again, if you're not familiar, I've done a retirement portfolio video, and the number one, we have the 3 pillars of it, and one of the pillars is income. And this is hardcore a fund that fits into the income bucket of that portfolio. The institutional backing managed by State Street, the powerhouse that created SPY, is ensuring the operational excellence. Okay, so these guys aren't new to the game. They're a big player. SPY is one of the S&P 500 followers. Then the value. It's cheaper than its rivals. It's backed by real assets. Ask that question. If you're charging a bigger number, do you really have are you doing the assets? These guys buy the assets. So they're constantly growing their net asset value. I personally put this as a buy rating for me, myself. And, I take it for do your own research. Again, this is not financial advice, but I put this, despite the geopolitical noise, the S&P remains resilient. SPIN is the quiet powerhouse that income investors shouldn't sleep any longer on. In 2026, the total return target is pretty much in that 10 to 12%. 8% yield with about a 2 to 4% capital appreciation. Once we get geopolitical noise down, quieting down, and get things rolling, you're going to see this fund change. So is it a good time to buy? That's for you to make a decision. How does it fit your portfolio? I'd love to hear how this one works. What do you think of this fund? Put a comment down below. And if you like this style of video, if you like what we're doing, please hit that like button, hit that bell notification. You don't want to miss a single one of our videos.
Thank you for watching. Press the